What if I told you the richest people on Wall Street aren't shouting into phones or making dramatic bets? They're quietly sitting at keyboards, running lines of code and solving equations. Hey, this is Coinrad, and today we're diving into the secretive world of quants. The math nerds quietly making billions with code. From algorithms to hedge funds and the occasional market meltdown, we're asking one big question. Can math really make you rich? All right, first things first, what even is a quant? A quant, or quantitative analyst, is basically a data scientist with dollar signs in their eyes. Their job is to take piles of market data, stock prices, interest rates, GDP figures, and who knows what else, and build mathematical models to predict how the market will behave. Then they write code to trade based on those predictions. No hunches, no buy-the-dip memes, just cold, hard logic. Think of it like this. Where traditional traders might go with their gut or follow financial news, quants rely on algorithms. It's the difference between a chef tasting the soup and a robot measuring every grain of salt with a laser. So how do quants actually make money? They build strategies, algorithms that look for patterns in the markets and act on them, usually faster than any human could. Some of the popular methods include statistical arbitrage, where the algorithm looks for small pricing inefficiencies between related assets and profits from the difference. Then there's factor investing, like betting on cheap stocks, or stocks that have upward momentum. And of course, machine learning models that teach themselves how to trade by crunching millions of data points. It sounds complicated, and it is, but at its core, it's just this. Find patterns, code them, trade them. And sometimes those models work really well. Let's talk about Jim Simons. He was a mathematician and code breaker who went on to found Renaissance Technologies, the crown jewel of quant investing. Renaissance's flagship fund, the Medallion Fund, is legendary. How legendary? Try this. Average annual returns of 66% before fees. Even after fees, we're talking around 39% per year. To put that into perspective, the S&P 500 averages about 10% a year. Simons himself became worth over $30 billion. And here's the kicker. The fund is so exclusive you can't even invest in it unless you work there. Imagine a money printer that only employees get access to. But Jim's not the only one. There's Ken Griffin's Citadel, which made $16 billion in profit in 2022. Yes, 1 year. There's D.E. Shaw, which used quant models and once employed a young Jeff Bezos. And 2 Sigma, another quant firm built like a tech company with machine learning and PhDs everywhere. So yeah, you can get filthy rich with math. But before you dust off your high school calculus book and open a brokerage account, let's pump the brakes. Because not all quant stories end with yachts and private jets. In August 2007, a bunch of quant funds started losing money, fast. Why? Because many of them were using similar models. And when one started to unwind, it triggered a chain reaction. Everyone was holding the same trades, and they all tried to get out at once. It was called the Quant Quake, and it showed that even brilliant code can create dumb chaos. Then there's the infamous case of long-term capital management. This fund was run by Nobel Prize winners, literally. They used sophisticated models to make highly leveraged bets, and for a while it worked, until it didn't. In 1998, after Russia defaulted on its debt, their models collapsed. LTCM lost $4.6 billion in a few months, and nearly took the entire global financial system with it. The Federal Reserve had to step in to arrange a bailout. What went wrong? One answer is overfitting. It's when your model is great at predicting the past, but terrible at handling the future. Model errors, like assuming markets are rational, and black swans, rare, unpredictable events that blow everything up. Even the smartest model can't predict what Elon Musk will tweet. So, are quants the future of finance? Honestly, they kind of already are. Most major firms now use some form of quantitative analysis. Even if you don't see them, the algorithms are running quietly in the background, making trades in milliseconds, adjusting positions, and reacting to market news before most humans can even blink. And it's not just the big dogs anymore. Retail quants are on the rise. Thanks to platforms like Quant Connect, Robinhood, and open-source libraries in Python, even individual traders are building models at home. Some of them succeed, most don't. But the tools are more accessible than ever. And now, with AI creeping into finance, deep learning, natural language processing, reinforcement learning, we're entering a new chapter. Imagine a trading bot that reads financial news faster than any human, predicts reactions, and executes trades before you've finished your morning coffee. But there's a catch. The more people use the same tools and ideas, the harder it is to stand out. The market evolves. Edges vanish. Models stop working. It's an arms race, and the algorithms are constantly trying to outwit each other. So, can you really get rich with math? Yes, if you're brilliant, disciplined, and a little lucky. Quants like Jim Simons prove that numbers can beat instincts, at least for a while. But the game is tough, and even the best models can crack under pressure. In the end, quantitative analysis changed finance forever. It turned Wall Street from a shouting match into a coding competition. And somewhere, in a quiet office full of glowing monitors, someone's writing the next billion-dollar algorithm, or their next spectacular failure. This is Coinrad, and if you liked this, hit that subscribe button. There's plenty more economic weirdness, history, and money madness where that came from.